Hello and good morning, everybody, and welcome to this Tuesday, June 10th, 2025 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats. Pleasure to be with all of you this morning. Futures appeared to be up this morning. Let's see. Well, they were kind of flat. I saw small caps were up, but let me give you the latest. Got about 30 minutes to go before the trading day starts. And we got the diamonds actually up 0.04%, so barely. The diamonds up 16 cents to 428.52. The S&P 500 or the Spider pre-market is up about a little more than 0.1%, so we're sitting at 600.53. We've got the QQQ, which of course tracks the NASDAQ 100. That's up about 0.2%, so we got slightly higher futures. IWM small caps actually doing much better, up about a little more than 0.4%. And that's up to 214.30. Had a big breakout on the Russell 2000, which we can talk about in a few minutes. But getting through that 211 area was kind of a neckline on what appears to be a reverse head and shoulder bottoming pattern off of that April 7th low. That was the reverse head. So we've had a really nice recovery, I think, off of that. So that's been good for the market. Let me go ahead and see if I can get things set up here for you. There we go. Let me go ahead and go into what we saw yesterday first. So I'll start off with the main, the dashboard, and looking at some of the recap here. You can see the Dow Jones yesterday finished flat, down 1 point. S&P 500 was up about 0.1%. That got us again over 6,000. So that was the second day in a row now we've closed over 6,000. Hadn't seen that since I think it was February 21st. Prior to the last 2 days, that was the last time we had closed above 6,000. So S&P 500, after going all the way down and hitting 48.35 from 61.44. So that was down over 1,300 points. We're now back only 140 points away from an all-time high on the S&P 500. So we've gotten back almost everything that we've lost or that we had lost. The NASDAQ 100 moving down a little bit. You can see down here was up almost 0.2%. NASDAQ did a little bit better, about 0.3%. I did see a little bit of catch up in some of the other areas of the market that had been lagging. So we saw some pretty constructive rebounds in some areas, healthcare and some others, materials, discretionary, which had been down recently. I think discretionary led yesterday. We'll go into that in just a minute. Mid caps gaining 0.25% yesterday. The S&P 600 small cap up nearly 1%. So really good action across the board. You can see the VIX yesterday actually finished up, even though the market was basically a little bit higher. That was back up over 17, but it's getting perilously close. If you're a bear, getting perilously close to that 16 level, where if you're in a bear market and you get a VIX that closes back down below 16, we've never within that same bear market gone back down to another low. So it doesn't bode well when you see the volatility index back down at this level. I've said all along, well, not all along, but from probably, I would say probably the last month or so, I've been saying we're not going back down to those lows. Those lows are over. We don't have the right kind of market environment at this point to worry about going back down there again. If volatility index was still hanging around 25, 26, 27, then, maybe. But a lot of the fear has come out of the market. We've seen really constructive moves back to the upside. We see AD lines, accumulation distribution lines, that have been soaring across all of our major indices, including all of the sectors as well. There's just no corroborating evidence other than just sitting back and saying, well, I think it should go lower again because I don't like the news, or I don't like that, or that's the only thing really to lean on. And that's not the kind of stuff that I lean on. I lean on the charts, and the charts are telling me we're going higher and we're going to set new all-time highs. So that's the way I've been approaching the market. Looking at the sectors, again, here's yesterday, consumer discretionary leading. There's materials, technology, and energy. Those were the four groups that led yesterday. If we go back and we look over the last week or so, you'll see technology leading, materials up there, industrials, even healthcare, which had been so weak. You can see it was up 1.08% or has been up over 1% over the last week. Here's how you can get a general sense of what's been working. I think obviously the best thing to do is just look at the charts. But if you want a relative strength indicator, you can use the scooters where ETFs are ranked against other ETFs. And communication services right now, the best looking at 79.0. Then we've got industrials and technology very closely behind. Those are 3 of the 5 aggressive groups. And the next one is financials, which is another one of the aggressive groups. The only one that's not in that top 5 is consumer discretionary, which still shows a scooter down at 29.8. But the good news is it's been outperforming staples over the course of the last 2 months. Even though the last week or so, maybe even the last 10 days, we've seen staples throughout the day doing a little bit better than discretionary, but there are no breakdowns anywhere. So what I'm seeing is just positive rotation. In other words, when you see a lot of money rotating into defensive areas of the market, and you've got a lot of other corroborating indicators that say we're topping, or we've already got indicators, technical chart price action that's telling us we've seen breakdowns, or maybe we have negative divergences, that sort of thing, that can be problematic. But when you've got a market that's been going straight up, and then you just simply go into a little bit of a flag, and I wouldn't even necessarily call it a flag because the S&Ps continue to break the new highs. So we just continue to go higher and higher. Same with the NASDAQ 100. Russell 2000, the IWM, which tracks the small cap Russell 2000, that just made a big breakout. I'll show you that chart in just a couple of minutes. But when you're seeing all of these groups breaking out and moving higher, the rotation periodically isn't nearly as bad as when we're coinciding with a lot of other warning signs. And that's the problem we have right now. There's just not a lot of other warning signs out there. So I just think it's healthy rotation where our primary aggressive groups have gone up, leading the market, and then we get a little bit of rotation and the others come up as well. If you look at absolute charts, you're going to see that just about every chart you look at across all major indices and sectors, and even most industry groups, they're moving higher, even though they may not be leading the market. Not every industry group, not every sector can lead the market. And when technology is leading, that's 30% or 30 plus percent of the S&P 500. So when you get leadership in that group, it's really hard for the other groups to lead. Because you're talking about a sector that, you got a piece, or you got a pie that's 100% of the S&P 500. When 30% of it, that's a big chunk. When that's outperforming by a pretty wide margin, it's going to be difficult for some of the other areas to outperform. And what we've seen is prior to the last 10 days, we saw discretionary leading. We saw communication services leading. And you throw those two in with technology, now you're talking about 50% of the S&P 500. And when they're leading, doesn't give any room for anything else to lead. So you're going to have laggards. You're always going to have laggards. But which ones are the bigger laggards in terms of relative strength? And I think right now it's mostly your defensive stocks. Let's take a look at the major indices. So here's the S&P 500, and this is what I was talking about. We just keep going higher. We had what appeared to be a little bit of a reversing candle after printing a negative divergence on the daily chart. Now, divergences don't look nearly as bad if you start stretching it out, looking with long-term perspective. And that's why I think the long-term is much more bullish. Short-term, we could be choppy. I mean, it would be hard to argue if the market took a break. I mean, we've come straight up from April 7th at 48.35 to now where we're over 6,000. I mean, that's 1,170 points off of that low to where we are right now. So that's, off of 48.35, 1,170 points is probably somewhere in the 23, 24% range. That's how much we've moved up in 2 months. Now, granted, we went down that much in 2 months, but we've essentially just come right back up to where we were prior to any of this downturn happening, prior to the cyclical bear market. And I find this to be very bullish. I also find that the action taking place entirely above the 20-day EMA, which is rising, I find that to be very bullish. And if we go down here and get rid of the RSI. Actually, we'll look at that in just a minute. Let's stick with this for now because I'll mess up my rotation of charts here. But anyway, this is the S&P 500. Check out the NASDAQ 100. Pretty much the same thing, moving up. Got a little bit of a negative divergence, but we've seen no breakdowns. We've seen no sign really of any kind of major rollover at this point. When I do see this, I will tell you that there's the chance. I'm not saying we're going to go do it, but there's always the chance when I see a negative divergence. If we lose the 20-day, there's a chance we could make a quick move down to the 50-day, which obviously would scare a lot of folks, probably get a little bit of a surge in the VIX again. But that right now on the NASDAQ 100 is probably about 9% below where we are right now. So if something negative comes out, we've got inflation reports coming up this week. There's ongoing discussions between the U.S. and China, trade talks. If something comes out that's negative, that's really negative, the market doesn't like, and we lose that 20-day moving average, there's a decent chance that if we lose the 20, we could go to that 50-day moving average. But, the way I approach the market, I don't want, the market can always do one of two things. It can go up or it can go down. I mean, I could just make that argument every day. But what I have said repeatedly, and what I'll say again today, is that I believe the stock market's going back to all-time highs. And I don't think it's going to be 5 years from now or 10 years from now. I think it's going to be fairly soon. I see a market that wants to continue pushing to the upside. The short term, the intermediate term is where I think the market gets a little bit more difficult to call, especially after you've had a big run like this and you do see a negative divergence print. And recently, we're not seeing the big hollow candles. We're seeing a little bit more of just, it's been pretty boring actually. I mean, the NASDAQ 100, look at these two candles the last 2 days. I'll zero in here for you. I mean, we don't even have much, movement to the upside or downside throughout the trading day. So it's been much more complacent, much more bullish. That's what bull markets feast on. And that's where bear markets die, because without that volatility and without that fear and some kind of panic in the market, bear markets die. And if you look back, just about every bear market in history, you'll see that once we get to a certain point on a rebound, market environment for the bear market is pretty much dead and buried. So I believe the market's going up, but the market's always full. It doesn't matter how bullish the market is. It always goes through periods where you could see 3 to 5% downside. With the exception maybe of 2017. I think that was 1 year where we went, or actually it was a year and a half, close to 2 years, where we went over 500 days without a 3% correction. But that's unusual. That was, coming out of that sideways consolidation for a year and a half, 2014 through early 2016. And then we, started moving up, and we just never really looked back for quite a while. This is a little bit different, though. We've been in a much more volatile environment here over the past few months. And so again, pulling back because of a story on tariffs or a story on the trade war and how the negotiations are going, or if we get one high print. And I think that's all it would take. I think there's a lot of folks still thinking we got inflation problems, which I don't think. But if we got one print that came in on inflation that was a little higher than expected, especially if it was the core CPI, which is due out tomorrow morning, that's something that if all of a sudden, instead of the 0.3% that's expected, what if it's 0.4 or 0.5? I'm not predicting that. I don't think it's going to be that. I think it's going to come in line or below expectations. But what if? Those are the types of scenarios we could see a little bit more selling. But make no mistake about it. If you told me right now I had to put my money into the stock market and I had to do it on the long side or the short side, and you said your holding period is 3 months, 6 months, a year, 2 years, 5 years, all of those time frames, I would be long. So again, you can't help but have a pullback from time to time, and we're going to set up for one, you would think, before we make big breakouts. Let's keep moving though. IWM, here was that breakout. I want to annotate this chart for you. There we go. So here is that neckline. And it's slightly upsloping. Also slightly upsloping was the shoulder to the shoulder. I usually like to do that in the dotted line. There you go. So you can see the left shoulder to the right shoulder is upsloping. Left side of the neckline to the right side of the neckline is upsloping. And so when you make the breakout, you know that you're clearing all the resistance when you have an uptrending neckline. Now, if I drew this a little different, let's say that the neckline on the right side had been down here somewhere, maybe at 207. First of all, I don't like those kinds of head and shoulder patterns because to me, it's you still got that downslope, which tells me we couldn't even get back to where the prior high was. And the thing is, when you break above a downsloping neckline, when you first break above it, you haven't taken out the key resistance. I mean, when you're in a downtrend, it's a series of lower lows and lower highs. You don't reverse that until you get past that last lower high, which is that 209 level. So if you've got a downtrending slope line or slope on your neckline and you break out above, say, 207, you still have to clear 209 before you technically have reversed the pattern. When you've got an upsloping neckline like we have right here, you technically on this move slightly above have cleared that lower high. So at this point, it's already given you a signal that, hey, the bottom is in. So when you come back down into the right shoulder, especially one that's upsloping, I'm looking at this point for a breakout, which is what we got here over these last couple of days. And when you do get these breakouts, sometimes they can be very swift to the upside. What I would look for at this point now, I think you have two key support levels on the IWM. I am no longer looking for 200 or 198 or any of that down here. I think you have the level right around the 210 area. And then you've got the rising 20-day, which is now up to 206.41. So even from 213, you've got maybe about 3.5% downside to that 20-day moving average. But I don't believe we're going to see a close below that 20-day. Maybe I'm wrong. But that's the way I would be trading the IWM right now. And as I've told members, when you get the test of the 20-day or when you get the breakout, those are times when you can get more aggressive if you are interested in like the leveraged ETF, like the TNA, that's triple the IWM. So good news is if we go from 210 back up to 240, and it's mostly in a straight line, a little bit of pullback along the way. But if we make that 30-point move, which is almost 15%, there's a good chance your TNA is going to get you about 45%. And this measurement, by the way, takes us not only to 240, but the measurement is from about 210 down to about 172, which is 38 points. So when you break above, it's an upsloping neckline. So we get through about 211. That takes us up to almost 250, which clears the all-time high. That's the initial target on this breakout. So anyway, I'm pretty bullish the IWM small caps, more so than I was a week ago because of this breakout. Let's take a look at tell you what I wanted to do here. I didn't have time to set it up, but I did want to show you, well, first the AD line. That's what I was going to show you earlier. So here's the AD line on the S&P 500. Let's just go through all of these. I've done it before, but I think it's worth the exercise. There's your NASDAQ 100. Look at that AD line. Again, that's the top line right here. And if you're unfamiliar with the AD line, I've talked about it a lot, but if you are new to the show, the accumulation distribution line is basically determined by where you finish on a candlestick relative to its high and low for that day. It completely ignores where you were at the close yesterday. So you could gap down 10% and then come back up a little bit and finish on the high of the day. You might still be down 8% for the day, but if you finish at the high end of that candle for that day, ignoring the gap, that's going to be a big positive for the AD line, because once the opening bell goes off, there was accumulation throughout the day. That's what it measures. That's where it's different than the OBV, on balance volume. On balance volume, if you finish down today from yesterday, every bit of the volume gets subtracted in the OBV count as you go across. If you finish up by 1 penny, all the volume gets added. Here, when you're looking at the AD, depending on how far up, like if you close right on the high, 100% of the volume gets added. If you finish right on the low of the day, 100% of the volume gets subtracted. But if you finish anywhere else on that candle, it gets adjusted based on a percentage from low to high. And that is the multiplier. Your volume's the multiplier times that percentage. So that's how the AD line works. So it's a little bit different than the OBV, and I like it better. I think it gives you a much better picture of what is actually taking place during the trading day, which is when the big Wall Street firms honestly can either get in or out. They can't do it on an opening gap. Have you tried to get in or out on an opening gap? I mean, the bid and ask are so wide. I mean, you might have a stock that's up 2%. You decide you want to jump in. You put in your 100 shares or whatever you get into, and you get it at a 4% gain. All of a sudden, it jumps 2% because there's no liquidity out there, and the bid ask is so wide. So that's why I like the AD line better. Anyhow, that's the NDX. Let's look at the IWM, and this is really the one that's made a major change. I mean, if you go back here over the last year, the prior move that we had up when we hit the all-time high, we were not seeing that AD line go up with price action. Look since March 7th, though. And better yet, look back to January. Or actually, this is December. That's when we bottomed on the AD line. All these different lows here, the AD line never went to a new low. So in my opinion, we were seeing accumulation, which to me is a little bit of manipulation, because the Fed saying, hey, we're not going to cut rates. We're going to wait for a while, and inflation, we're worried about that. And oh, by the way, we could have stagflation, and we don't know what's going to happen with the tariffs and the trade war and blah, blah, blah. Wall Street, in the meantime, was not distributing shares. They were, if anything, they were accumulating shares of small caps and large caps. And then when we finally started moving to the upside, the AD lines have exploded to the upside. So I find this to be very bullish. XLK, AD line, rising. XLY, rising. XLC, rising. XLI, rising. XLF, rising. Those are your 5 aggressive sectors. AD lines all moving higher. This is telling me, it's giving me signals. The market's being accumulated through all of this. This isn't distribution. This is nothing like what we saw back in January and early February when I said I was in 100% cash. And, there were just multiple warning signs that were suggesting that this market had no legs to keep going higher. I see nothing like that now. I believe this market keeps going higher. Let's see. So let me get back over here for a second, because I wanted to show you the S&P 500. And I'm going to come down here, and I'll show you how you can do this. But if you just put in price, I like to look at the price indicator for relative strength. And I'm going to give you the ones that I like to follow. These are what I call my sustainability ratios. I think I need 6 of them. I could do more, but these are primarily the ones I like to follow. So the first one I like is the QQQ versus the spider. That's a little bit more growth orientation versus value. Then I always like to follow XLY, XLP. I think that's one of the critical intermarket relationships to follow. The correlation between the direction of the XLY, XLP and the direction of the S&P 500 is very, very positively correlated. Then I like to do the IWF, IWD. That's large cap growth versus large cap value. And then this is another large cap growth, DJUS, GL, large cap growth versus DJUS value. I think I'm doing that right. DJUS. Actually, I think it's LG. Well, let me bring that up first and see if that's what it is. Yeah, I don't think so. No. Oh, yeah, there it is. Large cap growth versus value. Okay, so let's do just a couple more here. DJUS growth mid cap versus DJUS growth small cap. Oh, no. value mid cap, sorry. And then DJUS growth small cap versus DJUS value small cap. And I always like to make these heights a little better so you can see them better. And then we will make this chart bigger. All right, let's try that. So here is the S&P 500. Here is growth versus value, QQQ versus spider. Here is discretionary versus staples. You can see we have pulled back a little bit, but still we got an uptrend followed by what is likely to be, in my opinion, a bullish continuation type pattern, a little bit of a flag. Here's large cap growth versus value, just recently setting new highs. Here's another large cap growth versus large cap value, pretty much the same. Here's mid cap growth versus value and small cap growth versus value. Now, when we topped back in February, we topped right here. Look at what was happening to all these ratios while we were still going up and setting new highs. QQQ versus the spider went down. It came back up, but still never put in a new high. Discretionary versus staples topped in January, a month before the market did. The Russell 1000 growth, large cap growth versus value, topped at the end of December, almost 2 full months before the market topped. Same thing with the second large cap growth versus value index. Mid caps went a little bit higher. That actually topped in early February and started to roll over. And small caps topped back in December. So do you see the difference? The S&P 500 trying to go higher, but there was rotation out of growth over an extended period of time. And then when the market finally started to roll over here at the end of February, all of these ratios just absolutely imploded to the downside, every single one of them. So in my mind, the way I look at it is Wall Street was getting out while we were still setting the highs. All of us, well, not all of us, because here at EarningsBeats, we follow this information, but most retail traders were just drinking the Kool-Aid. I mean, in mid-February, we're at all-time highs, 61.44. What's not to like about the market? I mean, we had tariffs coming out. The market just kept rebounding, but it was rebounding with areas of the market that could not sustain that move to the upside. And instead, we were losing strength in all the areas that could sustain that move to the upside. Very, very damaging. The exact same scenario happened at the end of 2021, right before the big cyclical bear market in 2022. One of the many things I pointed to back then, which is why you have to be careful when the market starts going through, a multi-month phase like this, where growth areas that should lead the market to the upside, no longer lead and they start to fall apart. Tell me where that's the case here. Again, discretionary versus staples a little bit, although I follow an intraday index of staples or discretionary versus staples, and it's been incredibly strong. So, and again, what you're looking for when you start calling a top, you want corroboration, and this is where I'll have some members who will write to me and say, well, XLY, XLP is going down, the market's going up, we're topping. You're looking at one signal. It's a good signal. I mean, it's one of my favorite signals, but nothing else is corroborating it. And that's where I run into problems with trying to call tops every time we see one little indicator this calling the market is a jigsaw puzzle, and you got to get all the pieces together. You can't see the picture by holding up one piece. If I say, hey, market's bearish, I got this one piece. Well, I can't see the rest of the puzzle. I don't know if it might be, you might be holding up the leg, but it might be the leg of the bull and not the leg of the bear. So you got to put all the puzzle pieces together. For those of you that are new to EarningsBeats, go over to our website, EarningsBeats.com. And even those of you who have been with us for a while, if you haven't already done this, I don't know what you're waiting for. Go to EarningsBeats.com. You can definitely sign up for our paid service. You do get a 30-day free trial. You have to give a credit card just so we can get you set up in our system, but you'll have 30 days to try our entire service for free. And before your free trial expires, we'll reach out to you and tell you that your free trial is expiring, and that if you're not going to cancel, you're going to be charged the monthly rate. And oh, by the way, we'll give you an annual rate that is probably 50% lower on a monthly basis than the monthly rate. So, we're not going to just let it expire and not say anything. We're going to let you know. So if you want to try it out, try it out. Also, maybe if you're just seeing us for the first time, you don't really know anything about us, subscribe to our free newsletter. No credit card required. We've had tens of thousands of subscribers to our EarningsBeats Digest. Name and email address, all it takes. And you'll learn a little bit more about how we approach the market. And then maybe somewhere down the road, you might be interested in maybe saying, hey, this kind of seems like it's a style I like. I'm going to give their service a try. But at a minimum, you should be on the EB Digest. All right. Well, we just opened the market. So let's take a look at what is going on first. Go to the dashboard. Dow's open down just slightly. S&P up a little bit. NASDAQ up a little bit more. Small caps up a little bit more. Got the VIX down just slightly. Looking at the leaders, looks like Enphase, one of the renewable stocks that's been hit so hard, still trying to find a bottom. Tesla on the list, gaining 1.5% so far today. The down moves, Schmuckers down 7%. I don't know if that's earnings related. Seems to me like they report in July, but I could be wrong. Moderna down about 2%. Nothing really else there to look at. One other thing that we have done, and I plan to do it one more time, maybe tomorrow, is give away our latest chart list, which is our leading stocks chart list. I absolutely love this chart list because it is a momentum based chart list. So anytime, if a stock has been doing really well and it's in an industry group that's been doing really well, because these are leading stocks in leading industry groups. So if you got a really hot stock, but it's in a group that's not performing well, it's not going to be on this list, because if that group's been weak, sometimes carpet can be pulled from underneath the individual stock that's been doing well. We want leading stocks in leading industry groups. And I think this past week, there were like 43 of them. But if you are an EarningsBeats Digest subscriber, so if we go back over here, if you have signed up here, tomorrow's EB Digest that you receive will have a link where you can download the leading stocks in leading industry group chart list. And also will provide you a password. If you're a Stock Charts member, extra or above, extra or pro, you can download this list right into your account. If you're a basic member or a non-member of Stock Charts, you'll be able to download the list of stocks and you'll be able to look at each chart, but you won't be able to save it because you're not on the platform. You don't have an account with Stock Charts to save it. But you can write down the symbols. You can have it going forward. You have that information. And like I said, there's only we've done this 3 weeks now. Both the last 2 weeks, the average gain on the stocks in the list have easily surpassed both the S&P 500 and the NASDAQ. I think last week's was almost triple what the S&P 500 did. And if you know anything about diversification, you get 40 some stocks. I dare anyone to try and get 40 some stocks in a portfolio and outperform the S&P 500 2 weeks in a row. It's not an easy thing to do. But anyway, it's worked the last couple of weeks. I think it just makes perfect sense, because that's the way we build our portfolios, is with leading stocks and leading industry groups. And we've been crushing the S&P 500 since 2018. So this is a really, this is a list that traders, especially momentum traders, should be considering some of these stocks. So anyway, make sure that you check on, make sure you sign up for our free newsletter and get that list tomorrow in your EB Digest email. But let me show you the list, or let me just show you a couple of them. Maybe I'll show you last week's. Let me just pull that up here. So just go out here and pull up a chart and pull up So the leading stocks and leading industry groups. Here was the one that we had for last week. You can get this week, like I said, tomorrow, or if you're already an EB Digest subscriber, you'd have gotten it yesterday. We provided it yesterday as well. Anyhow, so what we do is we just compare it. So I have the S&P 500 in here, and then along with the individual stocks. And so I'm sure most of these are still on this week's list. So we can see what's happening today. And S&P, it looks like probably right about in the middle right now in the first 5 minutes of trading anyway. And we have a couple of them we have a couple stocks that are down. PRCH was actually one I just featured yesterday in the EV Digest. Netflix is down, but that's been on fire. Helmet Aerospace has been on fire. Actually, all these stocks, obviously, if they're on this list, they've been on fire. But sometimes getting these on pullbacks, maybe to test 20-day moving averages, can be a great strategy. Anyway, this list, if we go back, I don't know, let's go back a week. You can see there's Porch, by the way, up 13.89%, 10% on TTMI. And then we go down, and there's the S&P 500. It's probably, I'm going to say maybe about 60% have beaten the S&P over the last week. 40% have not. But again, what we're trying to do with all of these is, I mean, if you're out there looking at the entire universe of stocks, chances are you've got less than a 50% chance of finding a stock that's going to beat the S&P 500. I mean, if you look at any of the breadth indicators, you got a lot of small cap, especially small cap healthcare, biotech, which just tend to just drift lower and lower and lower. So if you're looking at breadth indicators, a lot of times many of these will show that less than 50% of the stocks outperform the S&P 500. But so far in this list, I think last week we had 31 out of 43. The week before, I think it was 29 out of 47. I'm talking about beat the S&P 500 for the entire week. You know, we put it out at the beginning of the week. And for that week, we had 29 out of 47 beat the first week. And I think we doubled the S&P 500, if I'm not mistaken. Definitely beat the S&P and the NASDAQ. And then the second week, we had 31 out of 43 of the stocks on our list beat the S&P 500. And that's what you want, momentum stocks that are beating. So anyway, I just wanted to point this out. There's some great stocks that you can look at, and we're going to be sending this out the beginning of every week. So as new leaders emerge, you're going to see them showing up on this list. So pretty cool. I think anyway, pretty cool new chart list that we have. And we have a bunch of chart lists. All right, let's see. It looks like small caps may be coming back down. NASDAQ, I don't know, up 27. Let's take a quick look at the, I know we're over time, but let's take a quick look at the spider. And I like to look intraday at these indices. So we made a move. I like to see, even if it's early, setting a new high. I like to get a new high because we're in a trend where we've been putting in higher highs and higher lows, at least this week. And if you look at the QQQ, QQQ has been more sideways, so it'd really be nice to take out the high from last Thursday, which is up at about 533. Right now we're sitting at almost 532, so we need a little bit of a boost there. IWM's been doing better. We did get the gap up today. It's pulled back a little bit, but clearly we've been trending higher here in the IWM. I think part of that is because of this reverse head and shoulder, this bottoming pattern that we've seen the breakout on this week. So that move on Monday at the opening bell on the IWM cleared 211 and went back down. We basically hit 210 and change, which was the neckline. So we gapped above the neckline, went back, hit the neckline, and then we moved higher. And so far, we've got this higher high, higher low daily print here for the last 2 or 3 days. So we'll see, if that continues. But that's what I would look for on the IWM. If I'm in the TNA personally, one thing that I'll do at least at a minimum is cut back on my exposure if we lose the low from the prior day on the IWM. That's just, one of my strategies. As long as we keep putting in a higher high, and especially higher low, I'll stick with my full TNA position. But once we start to at least, see a crack in the foundation, I'll cut back and then decide if I want to get back in. And if we go all the way back down, I would ride the rest of my TNA down to, say, a close down to 210. If you want to, you could give it a little bit more room down to the 20-day. I don't like to give it that much room. So we'll see how that plays out. But anyway, we're 10 minutes into the market now, so I'm going to go ahead and wrap this up. Listen, have a great rest of your day. Enjoy the rest of the week, and make sure you sign up for that EB Digest and potentially sign up for our service and check us out. Have a great day, everybody. Happy trading.